Welcome, everyone, to another deep dive. Today, we're taking a look at something pretty fundamental.
Yeah, we're really getting into the ultimate truth teller of the business world today.
Exactly. We were talking about the statement of cash flows, but, our source material today, it doesn't just, explain financial statements to you.
No, not at all. It's actually a pretty heavy critique.
Right. It actually goes after the almighty GAAP, generally accepted accounting principles.
Right, the golden rule book.
Yeah, and the sources argue that standard accounting rules might actually be hiding a company's true financial health. I'm here to guide you through this, and as always, I've got our resident expert to help break it all down.
Glad to be here. And yeah, GAAP is, well, it's the mandatory standard, sure. But it's basically a system of standardization, not necessarily a true reflection of economic reality.
I love that phrasing. So to really figure this out, we're using a guinea pig today, a specific case study from the text.
Yeah, we're looking at Metropolitan Manufacturing Company, or MMC for short.
Specifically, their 2016 financials. So, okay, let's unpack this. If you are someone who wants to, look past top-line profits and see how the actual cash moves, this deep dive is for you.
It really is. And I think before we can even start critiquing the rules of accounting, we kind of have to look at the raw materials first.
Right, like where did MMC even get its cash and what do they actually do with it?
Exactly. It's the basic sources and uses of funds concept.
So what are we seeing for MMC in 2016?
Well, looking at their sources, the obvious one is net income, which sits at $156,000.
Okay, pretty standard.
Yeah, but then there's a really interesting one right under it. Depreciation.
Wait, depreciation is listed as a source.
It is, yeah. They add back $56,000 for depreciation.
I mean, that feels super counterintuitive, right? Like an asset losing value is a source of funds.
It does sound weird, but you have to think about why it's added back. It was subtracted earlier for tax benefits, but it wasn't a real cash expenditure this year.
Oh, I get it. It's kind of like doing your personal budget, right?
How so?
Like net income is your actual paycheck.
Right.
But depreciation is like getting a tax deduction because your car lost value over the year.
Right, yeah.
You didn't actually write a physical check to a guy named Depreciation, so that cash is still just sitting in your pocket.
That is a perfect analogy. The cash never left the building. So when our goal is just tracking pure liquidity, we add it back.
Okay, that makes sense. But wait, looking at MMC's sources again, they also raised $130,000 in short-term banknotes.
They did.
Is borrowing money considered a source of funds, just like profit is?
It absolutely is. I mean, cash is cash when it hits the bank account, but the text adds a really neat detail here about why they did that.
Oh, what's the strategy?
Well, MMC likely borrowed those short-term funds because they usually come with a much lower interest rate.
Right, short-term is usually cheaper.
Exactly. And if you look at their uses of funds side, you'll see a $50,000 decrease in long-term debt.
Ah, so they're paying off the expensive debt with the cheap debt.
You got it. They're playing the spread to save on interest and then keeping the leftover cash to use in the business.
That's pretty clever. But, just seeing a number go up or down on these sheets,
Yeah.
it doesn't really tell you if it's fundamentally good or bad news, does it? We kind of need the why behind the numbers.
Yeah, numbers without context can be incredibly ambiguous. A perfect example from MMC's uses of funds is their inventory.
Right, I saw that. They had a massive increase, right.
Huge. A $298,000 increase in inventory.
Wow, almost 300 grand, just tied up in a warehouse somewhere.
Exactly. And as an analyst, you have to ask, does this mean they're prepping for a massive sales boom? Or did their sales totally crash and now all this unsold inventory is just piling up?
It's basically impossible to tell just from the raw spreadsheet.
It really is. The source actually brings up this wild example from 2014 to prove this point.
Oh, the oil company example.
Yeah, the major oil companies. In 2014, the price of oil dropped by roughly 50%.
I remember that, yeah.
So on their balance sheets, these companies showed drastic reductions in their inventory dollar values.
Because the price per barrel tanked.
Right. So casually looking at the numbers, they looked super lean and efficient. But the physical reality was the exact opposite.
Right, because nobody was buying.
Exactly. They actually had a massive increase in physical barrels of excess supply. They were drowning in oil, but the accounting value crashed, so it looked like they had less.
Oh, wow. So the dollar value completely hid the physical reality of the business.
Totally. And you have that same ambiguity with MMC's accounts receivable, which went up by $40,000.
Right, money owed by customers. Here's where it gets really interesting to me. The text takes a stance here and says that giving customers credit is a marketing investment.
Yeah, extending payment terms to win business.
But I've got to push back on that. Isn't a ballooning accounts receivable just a sign of, like, accounting sloppiness? Or maybe customers who are distressed and just refuse to pay?
Well, the truth is, it can be either. Yeah, I mean, the marketing investment angle is definitely the optimistic view. If
Yeah.
you normally give customers 30 days to pay, but you offer them 60 days to steal them away from a competitor.
Then it's the strategic move.
Right. It makes the customer happy. But on the flip side, if your terms never change and the receivables are just piling up anyway.
Then you have marketplace weakness. Customers are only buying because they can delay paying you.
Exactly. The raw numbers just demand critical thinking. You can't take them at face value.
Okay, so we've looked at the raw sources and uses, which, by the way, netted MMC a $26,000 increase in cash for the year.
Right. They ended up net positive.
But companies can't just publish a raw list of sources and uses, can they? Certified public accountants force them to use a very specific format.
Yes, they do. The official GAAP statement of cash flows.
And this format divides everything into 3 rigid buckets.
Operations, investments, and financing.
Okay, so looking at MMC's official statement, operations provided $23,000. Investments used $31,000.
And since it used cash, that $31,000 is usually shown in parentheses.
Right. Parentheses mean an outflow of cash. And finally, financing provided $34,000.
It seems like a perfectly logical way to organize things on the surface.
On the surface, sure. But I spotted a huge crack in the GAAP armor here based on the source text.
Oh, yeah.
Wait, the text says operations means making and selling your core products. But GAAP actually forces companies to put interest income and asset sale gains into the operations bucket.
They do,
If
yeah.
a company sells off an entire factory, how on earth is that a regular operation?
What's fascinating here is that GAAP can literally distort reality with rules like this.
I mean, selling a factory is a one-time thing.
Exactly. Selling underachieving assets definitely generates cash, and cash is good.
Yeah.
But it shouldn't be confused with operational success.
No, not at all. If you're masking a failing core business by selling off the corporate furniture, GAAP legally says, yeah, put that in operations.
And casual analysts will look at that top-line operating cash flow and think the business is booming.
Which is completely wild. So because GAAP includes these weird distortions, analysts look for a better metric.
Yes. They hunt for the ultimate buzzword, free cash flow, or FCF.
Right. The holy grail of discretionary funds available to grow the business. So how is traditional free cash flow actually calculated?
The standard formula is pretty simple. It's cash flow from operations minus capital expenditures.
Okay, so the cash you made from running the business minus the cash you spent upgrading or maintaining your equipment and software.
Exactly. It's supposed to show what is truly left over to implement profitable new opportunities.
So what does this all mean? The text points out a massive, massive flaw here.
It really does.
By subtracting capital expenditures but ignoring other things, traditional FCF basically implies that upgrading your equipment is a higher priority than paying your creditors.
Which is a very dangerous assumption.
I love the analogy the source uses. It literally compares this to remodeling your kitchen and then not having the funds to pay your mortgage.
It is the perfect analogy. And the danger in the corporate world is very real.
How so?
Well, think about executive incentive. If a management team wants to artificially improve its free cash flow to look better to Wall Street,
Oh, I see where this is going.
yeah, they might just stop making necessary capital improvements. They freeze R&D, they let the machines age out, they stop software upgrades.
Because shrinking the capital expenditure number makes their free cash flow artificially balloon up.
Exactly. The metric actually motivates really bad, destructive long-term behavior. They look highly disciplined in the short term, but they are hollowing out the company.
Just to juice a flawed accounting metric. That's crazy.
And all the while, the looming burden of their debt service, the mortgage, isn't even factored into the equation.
Okay, so if the traditional ACF metric is flawed and GAAP rules are too rigid, how do managers actually measure true financial health?
Well, the sources propose a solution. They introduce what they call a reconstructed statement of cash flows.
Basically a full-on rebellion against GAAP.
Pretty much. It's a two-step process to build a much better, more realistic version of free cash flow.
Okay, let's go through it. What is step 1?
Step 1 is to clean up operations. We have to strip out all that GAAP noise.
So moving that interest income we talked about out of operations and into investing.
Yep. And you move interest expense out and put it in financing. And critically, you take those one-time asset sales, like selling the factory, and move those over to investing too.
Okay, so now we have a truly pure operations number. It's just cash from making and selling the product. What's step 2?
Step 2 gets a little aggressive. You have to remove all changes in accounts payable from operations.
Wait, why remove accounts payable from operations? Isn't paying your vendors part of running the day-to-day business?
You'd think so, but the source has a brilliant insight here. Accounts payable is actually a form of financing.
Financing
It's
from
a-
vendors.
Yes. If you delay paying your suppliers, you create a short-term cash inflow for yourself. You're basically forcing your vendors to act as a bank.
Oh, wow. I never thought of it that way. You are holding on to cash that rightfully belongs to them?
Exactly. And it makes your operating cash look great in the short term, but it's risky.
Yeah, because if you rely on that, you risk ruining relationships. They might revoke early payment discounts or just refuse to ship to you.
Right. It's a financing risk, not an operational victory, so it belongs in the financing bucket.
That makes total sense. So we've cleaned up operations, we've removed the vendor financing. What is the new actual formula for free cash flow?
The new formula is cleaned up operations minus cash flows for debt service.
Cleaned up operations minus debt service. So no more subtracting capital expenditures.
Nope. You deduct the non-negotiable cost of your debt instead, the mortgage.
That is so much clearer. It measures actual financial health without the accounting noise.
It strips away the illusion entirely.
Well, wrapping this up, I think the core lesson from this deep dive is pretty clear. Accounting rules are totally necessary for standardized reporting, sure, but they are not the same as business reality.
Not even close. A true learner looks at the actual cash movements.
Right. Who is being paid, what is being delayed, and whether the core business is actually generating cash on its own.
Without relying on accounting tricks or vendor charity.
Exactly. So I want to leave you, the listener, with a final provocative thought to mull over today.
This is a really important one.
Think about how companies reward their CEOs. If executive bonuses and stock options are strictly tied to traditional free cash flow, as defined by GAAP,
Which they usually are.
right, how many corporate kitchens are being aggressively remodeled right now while the mortgage goes entirely unpaid?
It's a scary thought for any investor.
Are the metrics we use to define business success actually incentivizing the slow, quiet destruction of the business?
Something to definitely look out for.
Absolutely. Well, thanks for joining us on this deep dive. Keep questioning the numbers, and we will catch you on the next one.